Hello, this is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. And today's post was titled, "Are you willing to bank on it?" There's been a lot of things in the news recently about the banks, and in fact, a lot of talk about the recession coming to an end and the banks paying back the TARP funds. And I thought it'd be interesting to take a look at the banking industry and how it actually has performed on a fundamental basis through all of this. So I'm going to take a look at some of the major money central banks. So let's start with looking at Bank of America. And as you can see here, this is a 20-year chart on Bank of America, and the blue line is simply the normal price-earnings ratio. And I want you to notice that Bank of America, like all companies I've shown over and over again, had a very strong correlation to its earnings growth, which it had significant earnings growth from the period 1990, all the way through the end of 2006 before the mortgage debacle came. But what I want you to also notice is look how the stock price had, clearly correlated to the earnings drop after they got caught, like everybody did, with all the bad debt, the bad CDOs and mortgage obligations, etc. But I do want you to notice here at the bottom that the stock fell all the way down to $2.53 at one point this year, and now it's rallied back up to $13.20. So clearly the banks were probably a real good investment. But the question is this: when you look at a company like Bank of America and look at its track record here, you have to realize that a lot of the growth that was going on during this period of time was probably artificial. But I guess the question I want to pose today is, what is their core earnings ability? So, I don't like, this isn't my cup of tea, as I mentioned in my written post. I don't like to invest in these kind of things, but clearly there's a lot of money that has been made this year for those that had the foresight to buy Bank of America at $2 or $3 or $4 a share, and obviously speculate on a recovery. So I did a little calculation for us. I took our forecasting tool and I overrode it, and I put in an 8% growth rate. That's higher than consensus forecast. And I went out to 2011 and I put $2.50 of earnings in there. And the reason I did that was the thesis was simply this: back here in 2000, the company did earn about $2.38. Then they did earn $3 and $4. $4, $3.92, and then $4.65. The point is, if I assume that their core earnings ability, their normalized earnings growth, could be around $2.50 to $3 a share, and as the economy recovers, and as you might have been read, most of the banks are beginning to pay back TARP and so on, what would the future look like? So if you went out and put in a $2.50 earnings rate out in 2011, and then calculated Bank of America at its normal 11 times earnings multiple based on that, in 2 years from now, you'd have a $28 stock or a double. 2.5 years, you have a double. That's a pretty good rate of return, notwithstanding that we are still getting some dividend income, although I don't rely on this number as being an accurate number. Another example of the banks and what happened to banks would be Citigroup. And once again, you have some extraordinary growth going on in Citigroup, during this period when you had all the mortgage, proliferation of money and all the funny, mortgage collateralized debt obligations that these banks were, making a lot of money on. But then, of course, it obviously led to significant write-offs, which caused a collapse in the price. Now, Bank of America got down to 97 cents. It's back up. Citigroup got down to 97 cents. It's back up to, just under $3 or approximately $3 a share now. And the reality of it is, if you went back and did the same kind of thesis and looked at them having a core earnings ability of something like $2, $2.50 or something, which they clearly have been able to generate in the past. Once they, write off, finish with all their write-offs and get back to just what I'd call their core earnings, there could be some very interesting and intriguing long-term investments here. Now, one of the leading analysts in the country, his name is Dick Bove, and he has recently written an article or did a video in Forbes magazine where he believes the banks are probably intriguing now if you're willing to look 2 or 3 years out in the future. So Citigroup, is another example of a bank that has really changed. And then, look at Wells Fargo. This is a very interesting story, very consistent earnings growth, as you can see. The stock price correlated with that. Remember, this, the earnings were up here where this blue line was until we had this big collapse, which lowered the average number, down to 7.8%. But as you can see, stock price reacted to that, but they already are, forecasting, and the consensus is already forecasting some pretty good recovery in Wells Fargo. And as you can see, their stock price has rallied from $7.80 to $24. So oftentimes, crises like this can really be, great long-term opportunities. The theory of buying low and selling high is real. But of course, there was an awful lot of risk here, but some of the recent returns on these things have been interesting. And if they are getting better, they still could be good entry points to be buying them. Morgan Stanley, moving on to more investment banking now, had a very similar picture. You can see the long correlation between earnings and market price. Of course, like everybody else, they had to take all these charges off, all that bad paper on their books, and the stock prices collapsed. But once again, I want you to notice a strong recovery here. You know, they got down to $13.10. They've recovered to over $28 a share. And then finally, you know, Goldman Sachs. And by the way, there's a lot of talk of the investment banks starting to, you know, put high pay packages back in, which is going to be interesting to watch. And there's an awful lot of risk here. But Goldman Sachs has had a good recovery also. You can see the stock got down into the 40s and has now rallied back to $147 a share. So, you know, there you have it. Are the banks, you know, can you bank on the banks right now? You know, I'm going to let you decide for yourself, but I think the bottom line is that, you know, in every adversity lies a seed of a greater equivalent benefit. And when you look at some of the, you know, leading banks in the country after they've gone through all this, when they come out the other end, they're, you know, with the fact that their stocks are very, very low, justifiably so, I might add. But the bottom line is, you know, there may be some good long-term investment. I'd call it investment/speculation opportunities here for my way. But I just thought you'd find this interesting, and I hadn't really talked about them for a while, so I thought I'd share. This is Chuck Carnevale saying, you know, goodbye. We're going to be not posting for Friday, Saturday, and Sunday because of the holiday. Y'all have a great 4th of July. Drive safe, and God bless. Thanks for listening. It's Chuck Carnevale saying goodbye.